Securities and Exchange Commission now saying that cyber criminals hacked into the agency's files last year and accessed information that may have been used to give them a secret edge in trading. SEC Chairman Jay Clayton says that his agency learned just last month that, quote, an incident previously detected in 2016 may have provided the basis for illicit gains through trading, adding specifically a software vulnerability in the test filing component of our Edgar system, which was patched promptly after discovery, and it was exploited. It resulted in access to non-public information. Joining us right now, the Wall Street Journal's global economics editor, John Hilsenrath, on that. And, John, it's good to see you.
Morning.
Thanks for joining us. Well, let's kick off right here, and then I want to ask you about the Fed. But what's the damage here?
Well, we're still finding out what the damage was. It's interesting that this happened back in 2016, and we're just learning about it now. But what we think happened here is that hackers got into the Edgar filing system. This is the filing system through which companies can put out all of their reports, their 10Ks, their quarterly reports, their annual reports. And there's a number of different things that might have happened. The hackers might have been able to get their hands on this information and trade on it before it got out in public. It's also possible, as we state in our story today, and as SEC Chairman Clayton says, that individuals can sometimes put out false statements. Like there was a case a few years ago where a trader in Bulgaria put out a statement about a takeover offer of Avon and was able to make a few $1,000s. The offer never happened. Oh, God, it was fake. And but he traded on the uptick on that. So, the thief Willie Sutton once said he'd rob banks because that's where the money is. I think what we see right now is wherever the information is, that's where hackers are going. We've got Equifax, and now we've got the SEC. Yeah, and we're learning hackers roamed undetected in the Equifax computer network for more than 4 months before the security team actually uncovered the massive data breach. In terms of this Equifax story, this is getting worse. Yeah. Yeah, it sounds like what happened there is this is part of the game that hackers play, but they got into the system in March and just kind of lurked around for a few months. And we describe it in our story as someone breaking into an office and trying to find the doors where the knobs are unlocked. They lurked around for a few months until they could get their hands on this trove of information, more than 140 million individual files, but that's the latest story there, that this thing was going on for months before they found out about it. Yeah, it's true. Look, I want to move on to the Federal Reserve. Obviously, yesterday, the Fed announcing that it will, in fact, start cutting the massive $4.5 trillion balance sheet of bonds and other securities next month, nearly a decade after the biggest financial crisis in a generation. Fed Chairman Janet Yellen called the move a vote of confidence in the economy right now. Listen to this, John. I want to get your reaction.
The decisions that we've made this year about rates and today about our balance sheet are ones we've taken because we feel the U.S. economy is performing well.
The markets seem to feel that way as well, John.
Right. Absolutely. So, look, we've got an unemployment rate down to 4.4%, broader measures of unemployment that include people who are working part-time or coming down also. The economy is on track to grow more than 2% this year, so it's doing pretty well. The one hang-up that the Fed has is that despite the fact that the economy is on a pretty good track, we're not getting a lot of inflation. So people are saying, why tighten monetary policy when there's no inflation? They think that if they don't move now, that we're going to get either some financial bubble or inflation down the road, and they don't want to be behind the curve, so they're taking these steps now.
John, based on what we've seen in the market reaction, so you had the Dow and S&P 500 hitting all-time highs yesterday. There's been some of a sell-off in Treasury bonds, the yield going up a little bit more yesterday. Does that send the signal, at least when you watch the fixed income market, that faster growth is expected despite the unwind, or are investors worried about disruption to those bond markets where you don't have a lot of liquidity since the financial crisis because of regulations, and are investors worried that there's going to be some major hiccup as the Fed begins unwinding that $4.5 trillion portfolio? Right.
So, we had this event a few years ago called the taper tantrum, when the Fed started sending out signals that it was going to stop buying bonds, and the bond markets blew up not only in the U.S. but all over the world. You know, they have been so transparent with this. They've been signaling this for so long that there's no sign of that happening right now. And I think that's one of the reasons why we're seeing stocks at new highs. You know, if I were at the Fed, the thing that I would be getting a little worried about is a repeat, not of the taper tantrum, but of what happened in the mid-2000s when this is what Alan Greenspan called the conundrum. The Fed started raising rates and bond yields fell instead of rose, and we ended up getting a housing bubble out of that. So, you know, I think the worry has to be that the Fed doesn't move aggressively enough. You know, these bond markets remain as tame as they are, and we get new bubbles building up.
Yeah. Well, another thing that happened was as the Fed did that kind of easy peasy stair step of interest rate increases,
right,
the Wall Street firms got even more creative with coming up ways to package mortgages and get people into mortgages when they couldn't afford the homes that they were buying. So that was a lot of financial engineering on behalf of Wall Street.
Dagan, I think that's a really important point. You know, I want to use your term easy peasy because the Fed is doing the same thing again right now. You know, they had this very easy peasy policy back in the mid-2000s where they signaled very clearly every single step. It was extremely predictable, and the markets got complacent. And what you have to wonder is whether the Fed is being so predictable now that the markets are going to get complacent and do all kinds of risk-taking again that end up causing trouble down the road.
Yeah, it's a real balance to walk as we watch this economy recover. One step forward, two steps back in some regard. John, good to see you. Thanks so much.
Great,
John Hilsenrath with the latest there.